In this video, I'll be sharing with you easy tips to start investing in the stock market as a millennial. Hey guys, what is up? Welcome back to my channel, the best place for investing, trading, and the stock market. I'm definitely no millionaire investor and trader nor financial advisor or anything like that. But what I do know is how to start investing and trading in the stock market with small amounts of money and generate a source of income from doing that. If you're a millennial watching this video, chances are you don't have a lot of money lying around for you to invest in the stock market. And that was the same for me too when I first started out investing and trading in the stock market. I literally bootstrapped myself up from the ground and took matters in my own hands. And I self-taught and really learned as much as I could about investing and trading in the stock market. And having been there myself before, I know with certainty that it is possible to start with a small amount of money and still be able to start investing and trading in the stock market. That's why in today's video, I'll be sharing with you tips that I've learned along the way getting my feet stuck in the mud so that you can avoid getting your feet dirty and take a more straightforward path. So make sure you stick around to the end of the video because you don't want to miss out on these valuable tips. With that, let's get started. The first resource that really helped me get started in investing and trading is Rich Dad Poor Dad. Now, this book is a classic in the personal finance space and has helped countless of individuals in personal finance. And the reason that Rich Dad Poor Dad is a classic is because Robert Kiyosaki really brought into light what an asset really is and what is a liability. And he highlights the difference throughout this book. There are a lot of people who confuses an asset with a liability, and this really affects the way they deal with money and personal finance. Robert Kiyosaki defines an asset as something that puts money in your pocket and a liability as something that takes money out of your pocket. While the conventional thinking used to be that a house is an asset, Robert Kiyosaki challenged that thinking and said that because a house takes money out of your pocket through mortgages, loan repayments, insurance, and so on, a house is actually a liability rather than an asset. Now, for me, when I first read the book, I was taken aback because you will intuitively think that owning a house is an asset. And because we are always told by society that when we own our own houses in the future, that will be the biggest asset that we will own. So imagine being told that the biggest asset that we will own in our lives is actually a liability and not an asset. A house being considered an asset actually makes some sense because if we sell our house, we make some money from it. In fact, we make a tidy sum of money. But the more I think about it, the more Rich Dad Poor Dad makes sense. Because while we might actually earn some profit selling our houses when they appreciate in the future, and even that is a big if in today's financial climate, in the meantime, while we are owning our houses, we have to pay to maintain the house. Expenses such as mortgage payments, interest on those payments, fire insurance, and so on actually takes money out of our pockets. The Rich Dad Poor Dad book basically changed how its readers view assets and liabilities, and it certainly did for me. While it did not offer any strategies or ways to get started investing in the stock market, what it did for me, which I believe was more important, was to change my view of money. And this was really important because only when I started looking at money differently and truly knowing the difference between an asset and a liability that I decided that I wanted to start acquiring assets. And that is how I got started investing in the stock market, because investing, when done right, puts money in our pocket. And according to the Rich Dad Poor Dad definition, that is an asset. Now that we know the difference between an asset and a liability, and we know that investing is an asset because when done right, investing puts money in our pockets, the next thing is saving money. I know this can be the most boring topic for a millennial, but hear me out. Saving is essential if you want to start investing, because how can you start investing in the stock market if you don't have any money to start with? That makes sense, right? But you might be wondering, I can barely buy a decent meal for myself, and memes such as this and this are totally relatable. And I get it because when I first started out, I also experienced the same issues. In fact, back before I started investing and was scrapping by, instant noodles would be my go-to. A cup of instant noodles would cost about $1.50. To be fair, I live in Singapore and here we can get a decent meal at the food court for $4 to $5. But my thinking back then would be like, hey, if I buy a meal at the food court, it will cost me $4 and I won't get a drink. But if I buy instant noodles, not only will I get a meal, but I also get a drink. And that is how I ended up eating a lot of cup noodles back then. I'm not saying that you should live on a diet of cup noodles because that is really unhealthy. But that was how I saved money up here and there back then. I also tutored some kids and most of the money went straight to my savings. So that was how I saved money here and there, and over time, the money that I saved add up to a decent amount for me to get started investing in the stock market. The point is that there's no escaping the fact that you need some money to start investing in the stock market. And to get that money, you need to start saving. Now that we know that investing when done right can be an asset, and now that we have some money saved up to start investing, what should we invest in? The third tip to start investing in the stock market is to start with ETFs. ETFs are basically a stock that tracks an underlying index or industry sectors. For example, the SPY is an ETF which tracks the 500 largest companies in the US. So if you buy the SPY stock, you technically own a very small percentage of these 500 largest companies. If you are just starting out investing in the stock market, then buying an ETF is the most practical step that you can take to get started investing. When first starting out, many investors want to pick individual stocks that beat the market. But the reality is that 90% of the time, these investors who are starting out lose money. Instead of trying to beat the markets, I highly recommend investors, especially those who are just starting out, to invest in ETFs. Specifically the SPY or US ETF, because the SPY will always rise over time. Quick disclaimer, there will be periods whereby the SPY will decline, such as during the 2008 financial crisis and currently due to the coronavirus outbreak. If you want to learn more about how I invest and trade during this coronavirus period, check out my video over here. However, in the long run, the SPY will always rise in price. There are three main reasons why this is so. Let me break them down for you. The first reason is population growth. The global population is expected to reach 8 billion people in 2024 and is projected to continue to increase over the years. With more people on the planet, there will be a greater demand for goods and services. Companies in the US that meet this demand will continue to grow and increase their revenues and profits, and prices of these companies will rise accordingly. The second reason is inflation. With inflation, the prices of the goods and services that these US companies can charge will also increase. Revenues and profits of this company will also rise, and so do the stock prices of these companies. The third reason is that the S&P 500 only takes into account the largest and best performing companies in the US. For example, Yahoo used to be one of the most prominent technology companies in the US and the world, and was one of the companies in the S&P 500. But it lost out to Google in its battle to be the #1 search engine and is no longer a part of the S&P 500. Facebook, another technology company, gained prominence and only went public in recent times and is now part of the S&P 500. So the S&P 500 only includes the largest and best performing companies in the US. The stock prices of these companies are expected to rise over time, and since the US ETF represents and reflects these companies, it is also expected to rise over time. That is why if you are just starting out, this is the easiest and most practical tip to get started investing in the stock market. For the purpose of this video, I want to share with you the two resources that I use to help me invest in the stock market. The first resource is Thinkorswim. So Thinkorswim, or TD Ameritrade, is a US broker that offers an electronic trading platform. If you are just starting out in investing and want a broker which offers an intuitive platform for you to place your investments in without having to go on the phone and have an awkward conversation with a stranger on the line, then I highly recommend using the Thinkorswim platform. I personally use their platform when I invest in the stock market. Another amazing broker that I use is Interactive Brokers. Interactive Brokers is also a US company which offers brokerage services. Interactive Brokers allow you to track your portfolio performance so that you are able to see how your investments are doing over time. And that is really helpful because if you can't measure something, you won't be able to see whether it works. The second thing that I like about Interactive Brokers is that they offer really competitive transaction fees. When we invest in the stock market, we need to pay a sum of money to the brokerage firm to place our investments. And over time, these fees can add up. That is why one of the things that I look out for in a broker is their transaction fees. And Interactive Brokers offer one of the most, if not the most competitive transaction fees in the market as of this filming of this video. Those are the two resources that I use to invest in the stock market. I don't have any affiliations with these companies, nor do I receive sponsorship from them. I'm sharing them with you because I personally use them and I found them to really help me in my investing, and hopefully it can do the same for you. I hope you found this helpful because I was once in your position as a millennial who wanted to start investing in the stock market but who had no clue on how to start. So hopefully with this video, you get a clearer idea on how to start investing in the stock market. If you want to learn more about the stock market, make sure you subscribe to my channel because I release one new video about investing, trading, and the stock market each week. As always, to your financial success.